Welcome back, Turning Hard Times to Good Times. I am your host, Jay Taylor, and really pleased to tell you that one of our most popular guests, Michael Oliver, is here with me once again. And I should tell you before I say hello to Michael, I should tell you guys that his website is olivermsa.com. olivermsa.com to sign up for his letter, MSA, that's Momentum and Structural Analysis. I've been following Michael, and I think he's been on the show. I looked the other day, almost since about 2014, and he's just one of the most popular guests because he's a technical analyst, and sometimes I've thought of technical analysts as being kind of dry and uninteresting, but Michael mixes a lot of very colorful language with his numbers, and so I think it's one of the reasons, in addition to the fact that he's been spot on in so many markets for so many years, that he has a growing following, and we're really happy to have him with us again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
It's good to be back. And speaking of markets that you've been pounding the table for, markets that you have been, always just very, very adamant about, well, not always, but since the last year or so, you've seen silver as a thing that's likely to take off. I mean, you call gold the big mama, but when we enter a bull market in the metals, silver usually leads the way and beats gold hands down. Mm-hmm. Boy, are we seeing something today, right? I mean, I'm looking at 24.14 on the cash market now, Michael. That's up 5.12%.
Actually, it's about 24.21 right now. Okay. Anyway,
you're looking at
new highs.
You're looking at a futures market, though. You're looking at the near term.
Yeah,
the near term.
That's right. I'm looking at what these should be trading. The main point there is this: it's very subtle. Asset classes, okay, bonds are down enormous on the year, double-digit percents, okay, price-wise. Yeah. S&P is down 20%. That's off its low. NASDAQ 100, the leader index, is down 32%. Mm-hmm. Muni bonds, high-yield corporate debt, all down double-digit percents. Silver's up about 4% on the year. Mm-hmm. Gold is almost unchanged on the year. Okay, mm-hmm. Something's been going on for the last several months that we expected, and that was that large asset managers and wise investors who aren't looking at day-to-day panicky stuff are saying, hey, something's going on here in assets. One is that we've had a dozen-year bull market bubble in the stock market and related paper assets caused by free money, helicopter money, you name it, QEs, et cetera. And it went on for a dozen years. Mm-hmm. You go back and look at the 1923 to 1929 bull market in the Dow. Look at the mid-1990s to 2000 peak in the dot-com. Go back to the 2002 bear low and go up to the 2007 bull market peak and then the bear market. The percent gains of those bull markets in stocks were measured in doubles and triples from the low. Okay. S&P from 2009 to last year's high was a seven-fold move.
Wow.
For NASDAQ 100, it was a 16-fold move printed by the central bank. Okay.
Yeah.
When they create pricing errors in asset categories by changing the valuation of money and the flow of money goes somewhere, it goes, in one place, then it goes another over time. But it certainly was flowed into the equity arena over a dozen years, more so than it ever has in U.S. history. Now, you can believe that, it was economically justified, or it was monetarily generated. If it was monetarily generated, as we argue, then it's broken. The bubble broke in January for NASDAQ 100. It broke at the February close for S&P. At that point, we turned long-term major bear on those markets. We argued the bubble is broken. And normally when a bubble breaks, no matter what the central bank does to try to stop it, will not succeed. They fought the 2008, 2009 bear market all the way down and couldn't stop it. They couldn't stop the dot-com bubble break. They certainly didn't stop the 29 to 1932 collapse. So once the bubble breaks, it takes over. Reality takes over, in other words. Mm-hmm. And I think reality's taken over. The central bank isn't aware of this. They think they're gods and that they can, change reality. They did. Okay, the problem is reality's coming unwound. Well, now the problem is if it's coming unwound beyond their control, which most investors don't realize yet. They still think the Fed can, change reality either way. Mm-hmm. So they could soften and everything will be okay again. We argue, no, it can't. It's over with. It's a disaster coming. They created it. They broke the bubble as well. And now we're going to pay the consequences. Well, what are the central banks going to do once they realize, my goodness, we're not stopping, quote, inflation, meaning narrowly defined commodity inflation.
Right.
All we've done is break paper assets that we can't allow to break, like muni bonds and so forth. What are they going to do? Well, obviously, they're going to have to reverse and go back to what they do best, which is to print, and easy money, et cetera. What market knows that? I think gold does. And I think that's why gold is in a huge down year for assets, is now trading almost unchanged. Mm-hmm. And silver's actually up 4% on the year. So I think somebody knows that the monetary metals are about to take over as the key place to be. And our work says silver's the place to be of all on a percentage basis. Mm-hmm. It wouldn't shock me. I'm not going to forecast it when and how, but I think it could be quick, meaning within a year and a half or so that this crisis could unfold, in which case silver could go vertical in a big way. We know in the past it's been to $50 twice, so that's not a big deal. You go back to 50 again. Well, we've been there before. Okay,
sure.
Gold's well above those comparable. And if silver went to a normal ratio to gold that it's seen many times over the past 50 years, you could easily see $200 silver. Mm-hmm. Ludicrous statement, right? We're 28 now. I mean, we're 24 or something now, and I'm talking a tenfold.
Mm-hmm. Well, it's not ludicrous.
The S&P, yeah,
it's not ludicrous, because if you look at the money supply, I mean, you're talking about 16 times in the Nasdaq, 7 times in the S&P. You said this time, which raises another question in my mind, Michael. We're looking at those kind of multiples, increases in those markets compared to, you said, 2 and 3 times with the other previous bubbles. And then you look at the debt. As David Stockman was saying, that our debt cost has gone up 42% compared to last November. I mean, like it's on an exponential track.
The debt crisis is a variable that will come into play. And that's why, for instance, MSA is shifted focus. Instead of looking at tech, which is is the leader on the downside, just as it was the leader on the upside. So we look at Apple, Amazon, and so forth. But you got to look at banks. And we've been focused on them lately, and they have gotten suddenly weaker than the broad market over the last 3 weeks, like somebody pulled a light switch. And the S&P's down, 3-4% in the last 3 or 4 weeks, and banks are down 8-9%. What's going on there? Nobody's talking about it.
Well, certainly an inverted yield curve like we have, and Powell definitely seems to be holding tough, as long as he can anyway. And that has to be murderous for banks if they're borrowing short and lending long. And they're probably not lending that much because they know that the economic environment isn't that great. Mm-hmm. And consumers are up to their eyeballs in debt. Consumers now, the credit cards are pretty much tapped out. And delinquencies are starting to rise. Yeah. Yep. So banks aren't going to want to lend. So what does that leave Uncle Joe Biden to do? He has to give us some more money, doesn't he? He has to print some more and send it to us?
And ultimately at some point, the screaming will get into the ears of the Fed, and they're going to have to respond to it, because that's their main job, is to support the government's debt market. And if that ever comes in jeopardy, which we think it's in jeopardy, just like the stock market. Now, the recent rally we've had in T-bonds, for example, look at TLT, which is a popular ETF of long-term U.S. government bonds. We had projected a first downside target. Both T-bond futures, 30 years, and the TLT hit our target about 4 or 5 weeks ago, and went 1% or 2 beyond our downside target. Again, this is a bounce target, not an end of the bear market, and have bounced nicely. The question now is bounce in the T-bonds, meaning the drop in yields that we've seen, sustainable or not? We think it's non-sustainable. We think it is a bear market rally for T-bonds. And the problem, therefore, for portfolio managers is that 60-40 magic rule, you balance your portfolio, that kind of nonsense. They're both down big. Bonds have not been a safe haven. They've not been a, quote, alternative. And when I do this silly graph study that, what's the year to date of, since the close of last year, you get these big negative graph bars on the S&P, NASDAQ, T-bonds, you name it, all the paper assets. And here's gold trading unchanged on the year effectively, and silver's up 4%. What's going on here?
Right.
The Fed's
and I think that,
breaking, quote,
as you say, some of the big fund managers are probably starting to, we're heading into a new year. Although I think one of the things that might keep the equity markets from collapsing or declining a lot right now, there's a lot of window dressing, as I understand it, Michael. A lot of fund managers haven't wanted to be in those household name stocks, the big ones. But at the end of the year, they're committed to have, less than 5% or less in cash, and they have to put it to work. So they have to show at the end of the year that they're owning these household name companies. So they're jumping back in now. So I'm wondering if we might not today. I think the equity market was up a little bit. See, the S&P is up a little bit. Yeah, not much.
No,
but
it wouldn't surprise me. What do we have, 7-8 trading days left in the year? Something like that.
Right.
And it wouldn't surprise me that we see some calmness here. But it certainly isn't a Christmas rally. Mm-hmm. It's been a sell-off.
Yeah.
Last 3 or 4 weeks have been pretty sharp down. And therefore, we're that notion of the cyclical, the seasonal of the buy Christmas rally hasn't worked out. But I do think you could have stability between now and the end of the year. This is based on technical assumptions, not anything else. Yeah. But I don't think the stability means anything. I think it just is a pause, that's all.
I'd like to ask you about the dollar. There's something we had last week, a guest on my show that is an advocate of the dollar milkshake theory. And that theory holds that as long as the dollar system doesn't go out of business, as long as it stays intact, that the dollar will remain the strongest among the currencies in the index. And that will, with variation from time to time, because there's so, he argues that the other currencies are derivatives of the dollar, and they all have so much dollar debt that whenever you start to squeeze, when the Fed starts to contract, pull money out of the system, then it really causes them scurrying around to buy dollars, and so it drives the dollar up. They have to service their debts, and they need dollars to do it, and so they're out there bidding up the price of dollars. And do you buy that of course, no. if at some point in time, as you're arguing that the Fed will inevitably do, start to go the other way and start pushing money into the system, then it will have the opposite effect, I would think.
Yeah, it's one piece of paper versus another. That's what we're talking about here, the dollar index, which is primarily, by the way, the euro and the yen combined constitute like 70% of the dollar index. Okay?
Yeah.
So one piece of crappy paper versus another. But technically speaking, on the dollar, we've been both bullish and bearish over the last decade or so.
Yes, you have.
It's called major moves. Now, the dollar recently got up toward 115. In price, dollar index now. When it dropped back down under 111 a couple of months ago, we turned major bearish again because we had technical reasons to do that. And we said the next point of bounce might be around 103.60. Well, the recent low has been 103.50 and change. Okay, so we collapsed rapidly from just under 111 down to that next bounce point, and it's stabilized for the last week or two. Right now we're trading just under 104, so barely off the low. You might try to hold around here. It's both a momentum level, but it's also an idiot price chart level, meaning this. If you look at a monthly price chart of the dollar index, go back to 2010 or 11, you'll see there was a peak in 2017 in the upper 103s that did not get the 104. Then there was a peak in March of 2020 that got up to the upper 103s, but not the 104. And what have we done? We've dropped back into the upper 103s. Okay? So the price guys are buying the old highs. And it might play for a bit for them. They might be able to, make a little bit of trading money for a week or two or three. But if you ever close, I'd say if you drop back down under 103 or drop down to 103, price chart is even saying, the old ceiling is no good. I'm failing. Okay. Now, whatever rationale you want to put into that as to why that's occurring, you can. But we're looking at it technically, and I don't think the dollar is going to make it. I think it's begun the downturn again. And once you get back under 103, the public, I think that price chart technicians who are usually lag to momentum will agree. They'll say, oh, this isn't holding support. In which case, where's support? Good grief, we don't know. I don't think the movements in the dollar ultimately are that big of an issue for gold. If you go back over 50 years, you can find many times when the dollar has had a multi-year move in one direction and gold's gone the same way. Okay? So it's not always inverse to the dollar, gold. So I would not pay too much attention to the dollar in terms of assessing gold.
Right. Well, I definitely agree. Certainly, you've pointed out in the past, there's not that great correlation there for sure.
No.
And so you're expecting a weaker dollar longer term. I think all of my gold bug friends are. Some of the dollar milkshake theory people do too. But their argument is that until the system changes, that outside of the index, look at the Russian ruble, for example, and a lot of other currencies. And gold, of course, has done extremely well against almost all the currencies except the dollar. So I would think a weaker dollar would put some wind at the back of gold and silver as well, though.
Yeah, and who knows? We may have some major countries issue a gold-backed, money in it.
Well, I was just thinking, I want to, it would ask you, because if these metals get out of the, if they just take, they just take off like crazy, and there's no stopping them. It's got to send a message to some of these people that maybe you ought to rethink your monetary system. Yeah.
And some economists, even of the left and the right, I've seen, Nouriel Roubini, El-Arian, have criticized the Fed dramatically and said, what's going to happen here is not something normal. It's going to be horrible, talking economically and politically and so forth. So meaning they're saying this hasn't worked.
No.
This
I think
cycle, hasn't worked.
Yeah, I think even Dave. I think even maybe Jay Powell and some of the others. I mean, I was really, really, really shocked when David Stockman said on this show some time ago. He was the first one I heard. He was very sure that Powell was going to be tougher than most of the talking heads thought he would be. He said he believes that some of the Federal Reserve people, the people in the central bank, are really afraid of. I think he said torches and pitchforks coming at them. In other words. That's the kind of language I'd hear you use to talk, picturesque language. But there is a real fear. People are getting angry as hell if they can't put food on their table, Michael. Then it gets really bad.
Ron Paul just came out, and he's not an economist, but he's affiliated with the Austrian School of Economics and is a supporter of the Mises Institute, for example. So he came out recently, and there was an article, I think Zero Hedge even covered it. He said the result of this downside in the markets is going to be violence in the streets. And if you read the writings of El-Arian or go to look what he said on interviews, and even Roubini, remember he worked for Democrats, okay? They're effectively saying the same thing in euphemistic terms. That the outcome here isn't just markets, it's going to be political and in the streets. And,
and the question is how
different.
Yeah, the question is how they settle this problem. Are they going to do it with more government, more handouts, or are they going to go back towards a free market system? You and I hope the latter, but in the event, real quickly, Michael, oil and commodities in general. Just take 30 seconds.
Commodities in general, we expect another major up leg. Okay, we're monitoring it. We monitor the Bloomberg Commodity Index for it. It's a well-balanced commodity index. Some of these commodity indexes are way too heavily weighted to energy. Okay.
Yeah.
As far as energy goes, it was the leader in the first wave. Natural gas on a percent basis, oil on a percent basis. They led the Bloomberg Commodity Index rise from late 2020 when we got major bullish to the high of 9 months ago or so. We don't think the energy will lead the next leg. It may go up with the next leg, but we think it's more likely to be food related.
Oh, well, there you go.
Grains, sugar, for example, is flexing muscles right now. So we think that everybody who's watching energy, watch it, but it's doing what we thought it would do, which is to say after the major move we just had, go into a violent trading range, but at high price levels, which in and of itself is choking to the world economy.
Right.
Not that it goes down or up, just that it hangs around up here is choking.
Right.
The next leader would be foods, I think.
All right. Well, that goes to what we were just talking about, the concerns about hunger and famine and that sort of thing. It's the high prices beyond and then the government has to print money to hand out money to people so they can put food on their table. Goodness sakes, what a mess we've gotten ourselves into, Michael. But again, folks, it's olivermsa.com, olivermsa.com. Sign up for Momentum and Structural Analysis, MSA. And then you can hear these things before Michael comes on the show to talk about them, because he sends out frequent market timing. I mean, really market-sensitive information. And when things are changing, he lets his paid subscribers know. Michael, thank you so much for spending time with us again.
Thank you, Jay.